Hi there, welcome back. Today, we're diving into the concept of profit-taking. So what exactly is profit-taking? Profit-taking occurs when investors sell their assets, particularly stocks, after they have experienced significant gains to lock in those profits. This is a common strategy used by investors to realize gains and reduce exposure to potential future market declines. Now let's talk about why profit-taking happens. First, there are market gains. After a prolonged period of market gains, investors may believe that stock prices have peaked and choose to sell to avoid potential losses if the market turns. Then, we have economic indicators. Negative economic news or indicators such as slowing growth or rising interest rates can prompt investors to take profits, anticipating a market downturn. Next, there's portfolio rebalancing. Investors may take profits as part of regular portfolio rebalancing, adjusting their asset allocation to maintain a desired level of risk or to align with their financial goals. And finally, psychological factors play a role. Fear of losing gains can drive investors to sell, especially if they believe that the market is overvalued or if they have met their investment goals. So what impact does profit-taking have on the market? First, there's increased selling pressure. As investors sell their stocks to take profits, the increased selling pressure can lead to declines in stock prices. Second, volatility. Profit-taking can contribute to market volatility, especially if many investors decide to sell simultaneously, leading to sharp price movements. Lastly, sector-specific effects. Profit-taking might be more concentrated in sectors or stocks that have seen the most substantial gains, leading to sector-specific corrections. Strategic considerations are essential when it comes to managing investments. Timing plays a crucial role. Deciding when to take profits can be quite tricky. Selling too early might mean missing out on further gains, while selling too late could result in reduced profits or even losses. Another approach some investors take is partial profit-taking. This involves selling a portion of their holdings to secure some gains, while still maintaining a position in the market. It's a way to balance the risk and reward. A market correction is defined as a decline of 10% or more in the price of a stock, bond, commodity, or index from its most recent peak. Corrections are generally seen as a natural and healthy part of the market cycle, helping to prevent asset bubbles and excessive valuations. Several factors can lead to a market correction. Overvaluation is one such cause. When asset prices become too high relative to underlying fundamentals, a correction can occur as investors adjust their expectations. Economic indicators also play a role. Negative economic data, such as declining GDP growth, rising unemployment, or unexpected inflation, can trigger a correction as investors reassess risk. External shocks like geopolitical events, natural disasters, or significant changes in government policies can cause sudden corrections as markets react to increased uncertainty. Finally, as we discussed earlier, widespread profit-taking can contribute to a market correction, especially if many investors decide to sell simultaneously. Market impact. Corrections are typically temporary and usually last from a few weeks to a few months. They are often followed by a recovery phase, where prices stabilize and begin to rise again. Corrections are often accompanied by increased market volatility as investors react to rapidly changing prices and uncertainty. Corrections can lead to fear and panic among investors, especially those who are inexperienced or have a lower risk tolerance. This can sometimes exacerbate the decline as panic selling sets in. Investment opportunities. For long-term investors, a market correction can provide an opportunity to buy quality assets at reduced prices. Those with a long-term perspective often view corrections as a chance to invest in undervalued stocks. Investors may use corrections to enter or add to positions in strong companies or sectors that have been temporarily depressed in price. Corrections can also be a good time to reassess and rebalance portfolios, ensuring that asset allocations remain aligned with long-term goals. Risk management. Diversifying investments across different asset classes, sectors, and geographies can help mitigate the impact of a correction on a portfolio. Investors may use stop-loss orders to limit potential losses during a correction by automatically selling assets when they reach a certain price level. While corrections can be unsettling, maintaining a focus on long-term investment goals can help investors avoid making impulsive decisions during periods of market turbulence. In conclusion, both profit-taking and market corrections are integral parts of the financial market's natural cycles. Profit-taking reflects investors' strategy to secure gains after significant market rallies, often leading to increased selling pressure and temporary volatility. Market corrections, characterized by a decline of 10% or more from recent highs, serve as a necessary adjustment to prevent overvaluation and maintain market health. While these events can create short-term uncertainty and fear, they also present opportunities for strategic investors to buy quality assets at lower prices and rebalance portfolios for long-term growth. Understanding and managing these market dynamics is crucial for navigating the complexities of investing. Thank you for watching. Please like and subscribe.